In most cases, buying a home means getting a mortgage. But did you know that if you're building a new home, the type of financing is different? Basically, there are two options, a draw mortgage or a completion mortgage. There are benefits to both, so what does that mean for you? Tyler Pollock, our sales manager, is going to share the key points for you to consider when deciding your financing plan to help make the choice easier for you. Thanks for being here today, Tyler.
Thanks for having me, Nicole.
So this is going to be a little bit of a deep dive into two topics. What is a draw mortgage and what is a completion mortgage? Because those are the two different types of construction loans that people can expect. So what is a draw mortgage?
Draw mortgages, Nicole, are a mortgage that happen prior to the home completion, but generally through construction or prior to construction being completed. These mortgages advance funds throughout periodic stages in the construction process to help finance the build as we go. They're conventionally done with larger, more estate homes, but can be done with anything as simple as a fee simple property, even including a townhouse. Now, unfortunately, these mortgages aren't available on condominiums just due to the nature of the structured condominium plan, but they are available on all fee simple properties that way. What happens with draw mortgages is that the bank or the mortgage proceeds are advanced in stages prior to completion of the home, and those stages can be throughout the construction of the home, generally one happening at the very beginning, construction, foundation of the home up until framing. Rough-ins till drywall would be the second stage, and then usually right around the cabinets being installed for the third stage. And then of course upon possession of the home, that's when the balance of the funds would be coming over to the builder at that point in time, of course upon completion. Now, completion of a home too doesn't necessarily mean that all that exterior landscaping and driveways, sidewalks, all of that stuff is done, because of course we live in beautiful Alberta and we aren't always able to complete those things.
Yeah, you can't pour a driveway in December.
Exactly right. Don't want to be pouring it on snow, it won't last too long, right? So completion of the home is when the person is given the keys and the home is being ready to be moved into that way.
So when you're talking about those stages, you can think of those stages as different draws. So that's what makes it a draw mortgage. There's a draw of the funds at those stages of construction.
Exactly right, yes. And those proceeds are coming directly from your bank or your mortgage at that point in time.
So are these types of mortgages riskier for the bank, or like who's most invested? Is it the bank that's really kind of owning the funds and you can kind of sit back with that security and that confidence?
The bank and the purchaser do benefit from this type of mortgage. They're processing the funds out to a builder, but only in a portion where it relates to the stage of construction. So they're not taking on any additional risk. They usually do have a caveat registered to title, securing their risk on the property.
So who pays the interest then? Because you're accruing, if it's drawn at the very beginning, then there's interest starting from the day it's funded, like you said.
That's exactly right. And that interest portion most likely is going to be paid by the construction company or builder that is building your house. That does need to be determined by the builder, and you of course want to get confirmation that they are paying that interest portion of it, and in most times no principal has to be paid. But again, information that you want to confirm with your builder prior to jumping into a draw mortgage.
Now that interest payment, is that on the entire loan that was already said they're going to get, or is that on the portion that has been given to the builder?
So that is only on the portion that has been funded over to the builder. If your mortgage is $400,000, but they've only processed $100,000, the interest is only calculated on the $100,000.
Okay, so that's a draw mortgage. What is a completion mortgage?
A completion mortgage is when the bank only advances the funds at the end of the construction period or when you take possession of the home, get the keys and move on in. Completion mortgage side of things is you will get a firm mortgage approval up front, but again, you aren't locking in your interest rate until that home is completed. You will have a rate hold, sometimes anywhere from 60, 90, 120 days are the average in the marketplace. You can find banks out there that will do it for 2 or 3 years, but generally speaking, you will find that those interest rates are going to be higher than the 60 or 100-day lock-ins as well.
So when does it start?
A completion mortgage, you're going to want to be secured with the bank on your approval with a completion mortgage when you purchase a home. However, the completion mortgage itself and the funds are advanced when the home is completed and you take possession of that home, or you get the keys to it, right? And you move on in.
So when you sit down and write an offer, you need to have decided whether you have a draw mortgage or a completion mortgage.
That's 100% correct, yes. And if you are deciding to go with a completion mortgage, the funds won't be advanced at that point in time, but the bank or financial institution that you're going through will give you a firm approval for that completion mortgage with a rate hold that will sometimes last until the completion of the home, but not always.
So if you're building and it's new construction, you've got 8 to 12 months-ish.
Yes.
And that interest rate could change.
Exactly right, yes. Depending on your rate hold, the longer the rate hold goes, the higher the interest rate will generally be. Some rate holds you can get for 2 to 3 years, but the interest rate is going to be much higher than a rate hold that you get for 6 months.
So does it matter if you have a variable or fixed interest rate?
The interest rate or the rate hold would be affected depending on variable or fixed, but they would fluctuate the same that way depending on length of time of the rate hold that way.
Okay, so what are the benefits of a completion mortgage?
The benefits of a completion mortgage are they are easier to qualify for. They're a lot simpler on the homeowner and the understanding of how the mortgage will work. Also, this is the most common mortgage in the marketplace just due to the pre-owned homes where they're already completed and not currently under construction.
So this is sort of this is a similar type of loan to someone who is buying a pre-owned home that's already built and they're just signing 30 days and they move in.
Exactly right, yes. You can get these on a fresh build though, and something that hasn't started construction yet. You will need a final approval at the very beginning, but again, your mortgage will not start until the completion of the home.
So what is a negative of a completion mortgage then?
One of the negatives is that you need to be very cautious around your spending throughout the time that you've purchased the home to the time that the mortgage is actually funded. Your expenses on a monthly basis may differ if you want to go out and buy a new car or decide to go shopping for some furniture prior to the home being completed. The bank may require another income verification, which will affect what they're seeing in the end, and your mortgage could be pulled.
So also don't change jobs.
Don't
if you have a choice.
Yes, 100% yes. And in an unstable job market, if you do change jobs, generally speaking, you need about 6 months at that job to qualify for a mortgage at the bare minimum. So that could affect it as well.
So the bank may actually do another credit pull as well.
They could, yes, depending on your financial institution. The bank may do another credit pull. Some of them tell you up front, but that's sometimes not always disclosed up front, depending on how busy the day is. We all get busy, and it's definitely something you want to look into with your bank to see if they're giving you a final approval up front, or if there will be another verification of income at completion of the home, or usually 2 to 3 weeks prior to.
So it sounds like a home buyer can have a little bit of time between when they make the offer to when it's funded to potentially maybe save more money for the down payment. Are they allowed to change that before it's funded after it's built?
Yes, that's correct. Keep in mind that you still want to get a firm final approval before executing the contract with the builder, but if you save more down payment and you were originally doing 5% and you've saved up another 5 and you want to do a total of 10 at the end, that is definitely doable with a completion mortgage. That will also change your CMHC rate or your mortgage insurance rate at the end, so that'll lessen that the larger the down payment goes, right, up to a maximum of 20% down. But you are taking a risk by reopening that mortgage, because as soon as you change any detail with the mortgage, you will be reopening the mortgage, as I previously said, and there is risk that your debt to service ratios have changed and you may not be qualified again. So something we haven't touched on yet is appraisals. And appraisals happen whether it be a draw mortgage or a completion mortgage. There are several appraisals that happen with draw mortgages that sometimes the homeowner is responsible for that cost depending on the financial institution. Those appraisals will happen at each individual draw, but also at completion. With completion mortgages, they only happen once at the end and once at the very beginning to assess the property and its value.
So we've talked about a draw mortgage, talked about a completion mortgage. Why don't we give everybody some tips on how to get a mortgage?
Yes, for sure. Whether it be draw or completion, the process really remains the same. But one of the most critical points that you need to remember is that your documentation for your financial history is crucial. T4 forms, employment letter, any records that you may have relating to your financial history and your current financial state are of the utmost importance to provide to your mortgage lender moving forward.
So the first and foremost tip is to just get all your ducks in a row
Exactly
before
right.
you even start anything.
Exactly right. Make sure you have your down payment ready is a crucial part as well, whether that be RSP or gift from a family member.
And lastly, I think we have to talk about all of the buyer programs that are available. I'm not going to make you talk about every single one of them because I know there's a lot, but don't forget about those, right?
Exactly right. There's 2 buyer programs just from the federal government themselves for first-time home buyers when it comes into play with using your RSPs towards your down payment, or with the shared equity program from the federal government as well. But there's a number of programs through different financial institutions, your mortgage lender. It's definitely a good idea to talk and ask about those before you sit down and finalize your mortgage.
So there is a lot to the process, a lot of options, especially with these 2 types of mortgages. So really just work with the pros.
Exactly, and we have a lot of great area sales managers to get you over to the right mortgage lender to help with you and your family's unique needs.
Thank you so much for your time and your expertise here today, Tyler.
Thanks for having me, Nicole.
So if you are a house hunter who's considering new construction, be sure to like and subscribe to be notified of all our upcoming content. Thanks for watching and see you next time. Okay, so if you're... Okay, are we ready? This is it. Everybody get done.
Don't cry. Sorry, Nicole. I'm leaking from my eyes.